Before we get further into the details of options trading, let's reflect on why we trade options at all. Of course, the obvious reason is to make a profit. That is the primary reason that most traders get into options trading, the attempt to try and garner income through direct trading. But there are many other ways to make money, and options are a tool that go beyond the gross activity of income generation. This becomes explicitly obvious when one looks deeper into the institutional sides of options trading, where sometimes a more immediate goal might be something other than revenue. Institutional traders will use options to preserve capital, indirectly control stock positions, and as such influence parts of the market, ensure their portfolio against anticipated swings in the market, and hedge the risk of one type of position by taking on a counter position. When I first started trading with options, I looked at them mostly as a variation of stocks. This was a very bad point of view, and I almost lost my skin in that game. Later, as I became more knowledgeable, a lot of people in my circle of what one might call financially savvy friends told me about making an income off of stocks by using options as a form of insurance, which I think is probably the most common way people think of vanilla stock-based options. However, because of where I was in my options education at that time, while it made sense as a protective hedge, the insurance point of view didn't jive with me that someone could generate reasonable income through options trading in that fashion. It seemed slow, unnecessary, and oddly enough, too risky. The way it was being described to me, that is, using options to cover stocks, simply wasn't worth the risk of losing your stock position just for a few dollars. Plus, as it was, you'd have to have hundreds of shares of stocks on hand to begin with. At that time, I was learning that there were better ways to use my capital, and holding on to shares wasn't in that plan. Rather, purely using options was my plan. Why purely options? Because of the significant control that is gained in managing options over having stocks in the mix. Control is simply acknowledging that you, as an options holder, control what happens to 100 shares per contract of an underlying. Not all is rosy with controlling shares through options. You will lose out on some features that shares suffer beyond that of options. As an actual shareholder, you are a fractional part owner of the company. You can earn dividends if they are offered, and you can vote in shareholder meetings. Likewise, you can hold stocks indefinitely. There is no risk of the contract expiring because there is no contract. With options, you forego these privileges and take on other risks. That said, while a stock owner gets the privilege of being a shareholder and collecting any applicable dividends, the only choices they have with the position is to buy it or to sell it. If the market goes against their position, they either have to wait it out or take a loss. Options, on the other hand, allow for more degrees of freedom when it comes to managing a position, even possibly overcoming unrealized losses. Along with control, you gain leverage with options. For a few dollars, you can control thousands of dollars worth of shares. How much you control in terms of shares is measured through what is known as the notional price. It is easily calculated by multiplying the current stock price times 100 times the number of contracts that you have. And to be clear, that's the current price of the stock, not the stock price of the option. To calculate your leverage, simply divide the notional by your current liquid amount, and this will give you a percentage of how far you are leveraged. Generally, it is recommended that you keep your leverage under 4 to 1. Notional is critical to track, especially for traders who concentrate on selling premium. Since option contracts represent control of a certain number of shares, it's important to know how much a trader will need to have on hand in their account in order to pay for any stocks that end up being assigned. Notional changes as the price of the stock changes, so it can become especially important as the underlying stock rises or falls dramatically. A variety of other factors determine the overall impact of notional on one's portfolio, but that is a topic for a course on portfolio management as a whole rather than on options basics. Buying power is another concept related to leverage and control. You can think of buying power as the amount of collateral you need to have in your account in order to purchase options. In a restricted trading account, such as an IRA account, you may have to have enough notional on hand to cover the entire potential cost of the options trade should it go wrong and you end up being assigned. There are some very good reasons for this, part of which we'll touch on in the position section of the course. But as you can easily calculate, needing to have that much capital on hand hardly makes options trading seem worthwhile in an IRA account. What you need to trade in a more unrestricted manner is a margin account, where your broker will give you some leeway, that is, margin, to trade a little more freely. In a traditional margin account, you only need a small fraction of the amount of notional to trade, usually somewhere around 20% of the total notional, plus or minus some other considerations. This makes trading far more easy, but it also creates far more risk, since you can technically trade well beyond the actual amount of money you have in your account. Notional and buying power are important metrics to keep track of. Your broker will keep track of your buying power for you. Notional, however, is something that most traders will track themselves. In any case, both of these concepts should be adding fuel to the idea of how dangerous options trading can be if not managed well. Leverage is a teeter that can quickly raise an account's value, but can just as quickly cause it to drop if not well attended to or if the market goes wildly contrary to the trader's strategic trading assumptions. The last major, yet still basic thing you can do with options is hedge with them. Hedging is a very specific yet fundamental version of control. Hedging is one of the main reasons options was created in the first place, possibly as far back as 32 BCE in Greece by the philosopher Thales of Miletus, and in its modern incarnation in 1973 with the formation of the Chicago Board of Exchange and the Options Clearing Corporation. To hedge is to put a position on that will limit the losses of other positions you have. You can think of it as a form of insurance. If you own a stock, you can hedge the position by buying a call or put against it depending on what you think might happen in the near future. You pay money to someone for an option. In return, you secure the maximum loss you are willing to take. The thing is, you had to spend money in order to insure your position. Thus, your overall earnings are limited by that much. The person who sells you that hedge thus acts as a sort of insurance agent, comparatively speaking. You will hear this term often. The market makers and institutional advisors who drive much of the liquidity in the market do so through the act of hedging their positions under a variety of circumstances and often using more than just options, including futures and currency exchanges. Options trading is fundamentally about control and leverage. Hedging is a primary result of both of these elements. An options trader gives up some rights that normal shares would offer in exchange for more degrees of freedom, allowing for a far greater range of trading strategies under possibly more liquid and definitely more leveraged conditions, thus increasing earnings opportunities. And with added complexity. You will always find that there is always a trade-off when it comes to options trading.